Two worlds, one currency. But who truly holds the power to create the nation's wealth? The South African Reserve Bank is privately owned. Their legal dividend? Capped at exactly 10 cents.
The South African Reserve Bank is an anomaly. Out of all the central banks in the world, it is one of only a handful that is entirely privately owned. There are 2 million shares in total, distributed among private shareholders. By law, a strict cap prevents any single entity from holding more than 10,000 shares to ensure no one can easily buy a controlling stake in the institution. Here is where the math gets strange. A central bank commands a balance sheet in the hundreds of billions, but the SARB's private owners are legally capped at a maximum dividend of 10 South African cents per share every year. That means the absolute most an individual shareholder can make in a year is about $50. They receive virtually none of the bank's massive profits. Even with these extreme financial limits, the ownership structure makes people incredibly angry. The South African president appoints the bank's governor and sets its mandate. Yet political factions regularly stage major protests demanding the bank be nationalized. These 2 million shares represent the surface-level ownership of the bank, yet they barely factor into the mechanics of how the SARB actually controls the national money supply. Most people think banks take your savings and lend that exact money out to someone else. That is not how it works. Under a system known as fractional reserve banking, private commercial banks literally create money when they issue a loan. This flowchart shows how the math actually plays out. If you deposit $100, the bank keeps $10 in reserve and issues a $90 loan to someone else. That $90 is eventually deposited back into a bank, which keeps $9 and lends out $81. As this cycle repeats, that single $100 deposit cascades through the banking system, creating up to $900 in brand new, interest-bearing debt. This mechanism dictates the rhythm of the entire economy. During good times, banks issue massive amounts of loans to chase profits, expanding the money supply rapidly. But when the market shifts, they restrict lending. This sudden contraction causes steep economic recessions, locking us into a cycle of rapid expansion followed by inevitable collapse. Independent central banks exist to manage this volatility, yet historically, these institutions operate with very little democratic oversight, acting as secretive managers, what some economists call the princes of the yen. They frequently fail to constrain the massive overcreation of private credit. This geometric growth of credit transforms the banking sector into an extraction mechanism, requiring a constant influx of new debt to maintain its internal logic. Economists have proposed mechanical fixes to this exact problem since the Great Depression. The most prominent is the Chicago Plan, recently updated by the IMF under the name sovereign money. This schematic illustrates the core difference. Instead of allowing a cascade of loans, sovereign money requires full reserve banking. Every single dollar a commercial bank holds in a checking account must have 100% backing by central bank cash, stripping private banks of their ability to invent money out of thin air. Under this framework, only the sovereign state can issue new currency, and they issue it debt-free directly into the economy to fund infrastructure, fund public services, or direct payments to citizens. Because the state creates the money, the enormous profit generated by issuing currency flows directly back to the public treasury. By strictly controlling the total volume of money, the government can theoretically stabilize inflation and completely erase the boom-bust cycle. While sovereign money resolves the math of debt extraction, it forces a massive trade-off. It transfers total financial control from private commercial banks directly to a massive centralized state apparatus. If we recognize the danger of handing absolute monetary control to a central government, we have to look for a way to fix the debt machine from the bottom up. In South Africa, the historical ideology of Black consciousness provides a blueprint for this. Activists like Steve Biko argued that true liberation required complete psychological and economic self-reliance, building localized systems to escape dependence on an exploitative national structure. We can actually see this ethos operating mechanically in places like Sweden through institutions like the J8 Members Bank. This diagram shows a cooperative banking loop. Instead of extracting profit, members pool their savings to provide interest-free loans directly to one another. The explicit goal is ecological and social well-being, bypassing the traditional model of profit maximization entirely. By removing the profit motive at the local level, The JAX system demonstrates a functional, interest-free alternative to the standard debt multiplication model. Current political efforts focus on the identity of the bank's shareholders, leaving the mechanical engine of debt creation entirely untouched. The actual choice we face is much larger. We can continue patching an inherently unstable private banking sector. We can hand absolute monetary authority over to the state. Or we can choose to decentralize that power back into our communities. True economic sovereignty cannot be achieved by changing the shareholders of a bank, but only by breaking the monopoly of debt creation itself.
So what if I told you that like 97% of the money in your bank account right now wasn't actually created by the government?
Oh, yeah. That is a wild stat.
Right. I mean, it was basically conjured out of thin air by a private commercial bank, literally the very moment someone took out a loan.
It completely upends how most of us think about the economy, honestly. Like, we imagine money as this fixed resource sitting in a giant vault somewhere.
A giant vault of gold.
Exactly. But the reality is far more fluid and, honestly, a lot more precarious.
Well, welcome to the deep dive. If you are listening to this, you are the learner. And today our mission is to sort of peel back the floorboards of our global financial house.
We're getting right into the foundation today.
We really are. We are looking at a stack of incredibly revealing sources. We've got official documentation from the South African Reserve Bank, academic theses on central banking from South African universities, and historical journals diving into the Black consciousness movement.
Which is a fascinating angle on economics.
Oh, totally. Plus, we're looking at detailed analyses of alternative banking models, like Sweden's Jake Bank and the whole concept of sovereign money.
And understanding these systems, really getting to grips with the mechanics operating beneath the surface, that's the ultimate shortcut to understanding how modern society functions.
Absolutely.
It dictates who gets wealth, who gets debt, and why our economy is just constantly boom and bust.
So let's start with this massive anomaly sitting right in the middle of the global financial system.
Yeah.
When you think of a nation's central bank, you naturally assume it is entirely owned and controlled by the state, right?
Right. The government prints the money, the government owns the bank.
Exactly. But the South African Reserve Bank, or the SARB, which was established back in 1921, completely shatters that assumption.
Yeah, it's actually one of only a handful of central banks globally that have private shareholders.
Which is wild.
It is. In fact, it's one of only two in the world alongside the U.S. Federal Reserve.
And the math on this ownership structure is just bizarre. So there are 2 million shares of the SARB, and they're distributed among roughly 700 to 800 private shareholders.
But they can't just buy it all up, right?
Right. There are strict rules to prevent a monopoly. No single person can hold more than 10,000 shares. And, I mean, that limit even includes their associates or family members.
But the motivation for buying these shares, that is where it gets highly unusual. Because, in a standard corporation, you buy shares to get a cut of the profit.
Obviously, yeah, you want that dividend to grow.
Exactly. If the company does well, your dividend grows. But the SARB is governed by a specific statute that legally caps the dividend payout to shareholders.
And wait until you hear the cap.
Yeah, it's capped at 10 South African cents per share.
10 cents. I mean, if you hold the absolute maximum legal limit of 10,000 shares, the absolute most you can earn from your investment in a single year is 1,000 Rand.
Which is literally pocket change in the world of high finance.
Right. The rest of the bank's massive profits just go straight to the government. So owning a share in the SARB is less like owning a lucrative tech stock and, I don't know, more like holding a VIP badge or some ceremonial title.
It's almost entirely symbolic from a financial perspective. I mean, the shareholders are not running this bank for personal profit.
So what do they actually do?
Well, their primary power is just electing 7 non-executive directors to the board. And even then, those directors only act in a supervisory role over the bank's governance.
Okay.
They have absolutely zero say over monetary policy or setting interest rates.
Which really makes the intense political battle surrounding this bank so fascinating. Because there is a massive, highly publicized push to nationalize the SARB.
Yeah, it's been a huge talking point.
Right. And to be clear to the listener, we're not endorsing any political side here, just laying out what our sources say.
Yeah.
But in 2017, the public protector issued a report calling for an amendment to the Constitution to change the bank's mandate.
And then the political parties got involved.
Exactly.
Yeah.
In 2018, the economic freedom fighters brought an amendment bill to officially nationalize the bank. The African National Congress has also endorsed the idea of the state becoming the sole owner.
But the legal friction surrounding this proposed nationalization is pretty intense because under Section 25 of the South African Constitution, the state cannot simply seize private property.
Right, you'd have to pay them.
Exactly. Expropriating those shares would require fair compensation, which experts estimate would cost the public around 20 million rand.
Wow.
So critics of this move argue that spending 20 million rand to buy out shareholders is just a massive waste of public funds for what is purely a cosmetic change.
Because the government already holds the real power anyway. I mean, the president appoints the governor, the 3 deputy governors, and 4 independent directors. The state is already driving the car.
That's a great way to put it. And that intense focus on who owns those, symbolic shares often obscures the much more consequential debate regarding the bank's actual mandate.
Which is really where the rubber meets the road.
Yeah. Under Section 224 of the Constitution, the SARB is required to independently protect the value of the currency in the interest of balanced and sustainable economic growth.
Which sounds great on paper.
It does. But in modern central banking, that translates to strict inflation targeting. Basically, they're specifically trying to keep the consumer price index, which is just the general cost of everyday goods, hovering around 3%.
And this is where our source from the Daily Maverick comes in hard. They strongly critique this specific policy.
What's their main argument?
They argue that treating inflation primarily as a monetary phenomenon misdiagnoses the problem, especially in a developing, highly unequal society like South Africa.
To understand that critique, we really have to look at the mechanism of inflation targeting.
Right.
When inflation rises, the central bank's primary tool is to hike interest rates.
Right, which makes borrowing more expensive.
Exactly. And when businesses can't afford to borrow, they stop expanding, they stop hiring, and they might even lay people off. The explicit goal is to cool down the economy by actively suppressing consumer demand.
And the Daily Maverick argues that in a country already facing, catastrophic unemployment and collapsing public infrastructure, actively suppressing demand to hit an arbitrary 3% target is basically sacrificing job creation.
It's prioritizing numbers over people, essentially.
Exactly. They advocate for a developmental approach. So instead of the central bank operating in total isolation just to tweak interest rates, they suggest it should actively coordinate with the Treasury to support productive sectors and fund real-world job creation.
And that tension between strict monetary independence and developmental coordination, that's a global debate.
Oh, for sure.
But the sheer focus on the central bank's interest rates really brings us back to that statistic you mentioned at the very beginning of our deep dive. The reason central bank interest rates matter so much is because of how the rest of our money is created.
This is the hidden architecture that absolutely floored me when reading the sources. Let's pull from the University of Cape Town paper and the sources analyzing the JA Bank.
Because they really detail the reality of fractional reserve banking.
Yeah. So when a commercial bank approves you for a mortgage or a business loan, they are not going into the vault, taking someone else's physical savings and handing them to you.
No, not at all. They are literally just expanding their balance sheet. The bank types the numbers into your account, and in that moment, new money enters the economy.
It's basically magic.
Basically. They're legally required to keep only a tiny, tiny fraction of actual central bank cash in reserve to back up those deposits. Hence the term fractional reserve.
I like to think of it like a magical cloakroom.
Okay, tell me.
So you hand in your winter coat, and the bank gives you a claim ticket.
Right.
But then the bank prints 9 more claim tickets for that exact same coat and hands them out to 9 other people.
Oh, wow.
Yeah. They're just betting that all 10 of you won't show up to claim a coat on the exact same day.
Because if you do, that is a bank run. That analogy perfectly captures the illusion of liquidity. And the systemic danger embedded in this mechanism is profound because, like you said, 97.2% of the money supply is created by private banks issuing loans.
Which means virtually all the money in our economy is born as interest-bearing debt.
Right. Every rand, dollar, or pound created this way comes with a catch. You owe the principal back plus interest.
So mathematically, there is always more debt in the system than there is actual money to pay it off.
Precisely. And that specific mechanism is why modern economies demand constant perpetual economic growth.
We just have to keep growing to outpace the debt.
We have to keep producing and keep borrowing new money just to pay off the interest on the old money. Lord Adair Turner, the former chairman of the UK Financial Services Authority, actually delivered a speech to the SARB where he frankly admitted this.
What did he say?
He said that banks, unless strictly controlled, will create, and this is a quote, suboptimally unstable quantities of private credit.
Suboptimally unstable quantities. That is a very polite, bureaucratic way of saying they will blow up the economy.
Yeah, it really is, because the dynamic creates a massive systemic risk. The system is inherently pro-cyclical.
Right.
Think about the psychology of a banker during an economic boom. Times are good, people are employed, so bankers are optimistic. They just pump out loans.
Flooding the economy with new money.
Exactly. But a lot of that money doesn't go into building new factories or real businesses. It goes into buying existing assets like real estate or stocks.
Which just drives up housing prices and creates massive speculative bubbles.
And then the bubble pops, the economy wobbles.
And suddenly the bankers are terrified.
Right. They pull back, they stop lending. And because old loans are being paid off, but new loans aren't being issued, the actual supply of money in the economy physically shrinks.
Which violently exacerbates recessions, leading to, mass bankruptcies and foreclosures. But hold on, let me push back for a second. If we look at the core function of capitalism, don't we need that liquidity? I mean, without commercial banks creating credit out of thin air, a young couple couldn't buy their first home. An entrepreneur couldn't get a factory off the ground. Don't we need private banks to grease the wheels of commerce?
It's a fair point. The economy absolutely needs liquidity, but the crucial question is who provides it and under what incentives.
Okay, fair.
There's an IMF historical review cited in our Open Democracy source. They looked at centuries of banking data, and they found that allowing private institutions to issue the nation's money is closely associated with extreme financial crises.
Not a great track record.
No. Extreme crises, massive wealth inequality, and unsustainable debt buildups. Because the profit motive of a private bank naturally pushes it to lend into lucrative, speculative asset bubbles.
Rather than risky, real-world productive businesses.
Exactly.
So, if a centralized, debt-driven banking system is structurally rigged to create inequality in cyclical crises, the obvious question is, what happens if you just bypass the banks entirely?
That is the big question.
Can you decentralize economic power and return it to the community level?
And our sources point us towards some fascinating alternatives that attempt to do exactly that. For instance, we can look at the Black consciousness movement in South Africa.
Specifically, the initiatives led by Steve Biko in the rural Ciskei villages in Yoka in the 1970s.
Right. Because when most people think of Black consciousness, they think of a profound psychological and political awakening against apartheid.
But these historical journals highlight that it was fundamentally an economic philosophy, too.
Very much so. The core principles were self-reliance and community empowerment. They were deliberately fighting against a highly centralized, exploitative system designed to extract wealth from local communities.
So how did they put that into practice?
Well, the initiatives in Zinyoka, like community health clinics and trust funds, were grounded in shared resources and local business ownership. The idea was that true political liberation requires economic liberation.
You have to take control of your local economy.
Exactly. You pool your resources rather than relying on a centralized banking structure that doesn't serve you.
And if we take that philosophy of community cooperation and fast forward to the modern day, we actually see the mechanics of a community-driven financial system in the JK Members Bank in Sweden.
I love the JK Bank example.
It's amazing. JK operates on a strict principle of zero interest. They fundamentally reject the idea of making money from money.
Because their model is built on an ideological foundation called deep ecology.
Deep ecology, right.
Yeah, it's a deliberate shift away from the concept of homo economicus, that theoretical economic model that assumes humans are perfectly selfish, isolated, and greed-driven.
Right, the idea that we only care about maximizing our own profit.
Exactly. Deep ecology attempts to build financial systems around cooperation, reciprocity, and the sustainable sharing of resources.
And the mechanics of JK are brilliant. You only get out what you put in.
Yeah.
So if you want to take out an interest-free loan to, say, renovate your house, you have to save an equivalent amount in an interest-free account over time.
Your savings act as the liquidity that allows other members to borrow.
Exactly. But I know you're probably wondering how they handle risk, right? Like if they don't charge interest, how do they cover the losses if someone defaults on a loan?
Yeah, I was actually just thinking that. The math doesn't seem to work without interest acting as a buffer.
They handle it through shared equity and administrative fees. So members pay a small fee to cover the bank's operating costs. And when you take out a loan, a tiny portion of your mandatory savings is placed into a shared risk pool.
Oh, I see.
Yeah, so if someone defaults, the collective pool absorbs the hit. It is collective security rather than individual profit maximization.
Kind of like a community tool shed instead of a corporate hardware store.
I love that analogy.
You borrow a power drill when you need it, but you also donate a circular saw to the shed for others to use. You're pooling physical utility.
By stripping away the profit motive, money stops being a commodity that investors hoard and speculate with. It returns to being a simple, neutral medium of exchange.
And because JK doesn't play in the global financial casino, they are totally immune to international credit crunches.
The stability of that model is undeniably great for its members. But let's look at the limits of this.
Okay, let's play devil's advocate.
A zero-interest, community-reliant model sounds incredible for a tight-knit Swedish cooperative or a local initiative in Siskai. But there is no way a zero-interest savings pool scales up to fund a multi-billion-dollar national infrastructure project, right?
Right.
I mean, can it finance global shipping routes or the construction of power plants?
And that is the critical limitation. Local cooperatives are a vital piece of a resilient society, but fixing the macroeconomy, funding massive public works, requires systemic reform at the national level.
Something much bigger.
Yes, and that brings us to the most sweeping alternative proposed in our stack of sources, sovereign money, which is sometimes called full reserve banking.
Okay, let's work through the logic of sovereign money. If the core problem is that private banks create money as debt, the proposed solution is basically just removing their power to create money.
Exactly. Under a 100% reserve system, the magical cloakroom is permanently shut down.
So every single deposit a bank holds must be fully backed by actual physical central bank cash.
Right. If the bank wants to lend out a coat, it actually has to have that physical coat sitting in the back room. They can only lend out money that already exists in a savings account.
They can no longer expand their balance sheet to conjure credit out of thin air.
No more magic tricks. And this represents a monumental shift in power. Because if commercial banks aren't creating the money supply, the state, through the central bank, becomes the sole creator of all money.
The mechanism of how money enters the economy changes completely. Like currently, money enters as a private loan, burned with interest.
Right.
But under sovereign money, money enters the economy debt-free through government spending.
So instead of a commercial bank creating R1 billion to lend to a private equity firm so they can buy up residential real estate,
Which we see all the time.
yeah. Instead of that, the government's central bank creates R1 billion and hands it directly to the Treasury to build hospitals, schools, and bridges.
So the money directly boosts the real productive economy, rather than just inflating financial asset bubbles.
And the central bank's role shifts entirely. Instead of endlessly tweaking interest rates to manipulate commercial lending, they simply monitor the economy's output.
Okay.
They determine how much the money supply needs to grow to match the real growth of goods and services, and they issue exactly that amount of debt-free money.
Now, this immediately triggers alarm bells for me.
Why is that?
Because if the government can just print debt-free money to build bridges and fund programs, isn't that just a guaranteed mechanism for hyperinflation?
The classic fear.
We all have this mental image of people pushing wheelbarrows full of worthless cash just to buy a single loaf of bread.
Right, but the Open Democracy source actually addresses this directly. They argue that it is a historical myth that government-issued money is inherently inflationary, while bank-issued money is safe.
Okay, how so?
To understand why, we have to look at the actual mechanism of inflation. It's simply too much money chasing too few goods.
So it's about the ratio of cash to stuff.
Exactly the ratio. If you look at history, governments typically trigger hyperinflation during wars. During a war, a government prints massive amounts of money to build tanks, fighter jets, and munitions.
And they pay factory workers to build these weapons.
Right. But consumers can't buy tanks. So you have a massive influx of cash in the pockets of the public, but the amount of consumer goods on the shelves hasn't increased at all.
Actually, consumer production usually drops during wartime.
Right. And that massive imbalance is what drives up prices. But in peacetime, the mechanism works differently.
Radically differently, I'd imagine.
Yeah. In peacetime, sovereign money is injected to build infrastructure that actually expands the economy's capacity. So if the state prints money to build a new freight railway, that railway lowers the cost of transporting goods for every business in the country.
It makes the whole economy more efficient.
Exactly. As long as the central bank manages the money supply to strictly match the actual growth of goods and services, inflation remains stable.
Okay, but taking away the power of commercial banks to issue credit isn't a silver bullet. Because the paper from the University of Cape Town offers a strong warning about the unintended consequences of sovereign money.
Which is?
Specifically, The risk of shadow banking. The UCT paper points out a fundamental reality. The economy has a genuine organic need for continuous liquidity.
Sure.
Businesses need short-term funding constantly just to make payroll while waiting for invoices to clear. The plumbing of the economy needs water flowing through it.
So if you restrict traditional banks so tightly that they can only lend out fully backed deposits, that massive demand for credit doesn't just evaporate.
No, it migrates. It's like building a dam to stop a rushing river.
Oh, that's a good way to look at it.
Right. If the demand for credit is still flowing, it doesn't just disappear. It carves a new, hidden path around your dam.
You risk an explosion of unregulated shadow banking institutions.
Exactly. Hedge funds, specialized private lenders, and tech platforms will just step in to provide that credit, completely outside the view of national regulators.
So you might solve the debt creation problem in the highly regulated banking sector, only to push all the systemic risk into the shadows where you can't even manage it.
Which means any transition to a sovereign money system would require an incredibly sophisticated regulatory net to capture the entire financial ecosystem, not just the traditional banks on the high street.
It would basically require a total redesign of financial regulation.
We have covered a massive amount of ground today.
We really have.
We started by looking at the curious 10-cent dividends of the privately owned SARB, uncovering how fights over central bank ownership often miss the real debate about mandates and demand suppression.
We explored the hidden debt engine of fractional reserve banking, realizing that private banks basically conjure our money supply out of thin air, requiring constant, unsustainable growth.
And we explored community-driven alternatives, from the self-reliance of the Black consciousness movement to the zero-interest shared equity of the Jake Bank.
And finally, we scaled all the way up to the macro solution of sovereign money and the risks of shadow banking.
The vital takeaway for you listening is this. Understanding these systems strips away the illusion that our current financial architecture is a law of nature.
It isn't physics. It isn't gravity.
No. It is a human-made system built on specific historical choices, political compromises, and economic assumptions. And as these diverse alternative models prove, from local cooperatives to sweeping national reforms, it can absolutely be redesigned.
That fundamentally changes how you look at the world once you realize that.
It really does. But I want to leave you with a final thought to mull over, something that builds on everything we've unpacked today. If we do move toward a world where the state takes back total centralized control over a sovereign money supply, how might the rise of programmable digital currencies, like central bank digital currencies, change the game?
Yeah, that is the incoming frontier of monetary policy.
Right, because if the central bank issues digital money directly to your smartphone wallet, they can program it. They could issue money that expires if you don't spend it at local businesses within a month, heavily boosting community empowerment.
But the flip side is that they could also track, monitor, and approve every single purchase you ever make.
Exactly. Would a sovereign digital currency be the ultimate tool for equitable economic development, or the ultimate tool for centralized surveillance? Something to chew on.
An incredible question to end on.
Thank you so much for joining us on this deep dive. Keep looking closely at the hidden blueprints around you, and keep questioning the systems that govern our world. Catch you next time.